Welcome to Not Your Mother's Housing Market, the podcast where we dissect and discuss emerging trends in real estate because the 21st century market requires 21st century strategies. I'm Katie Keaton, your Southwest Washington realtor with Realty One Group Pacifica, and I am joined by
Gabby Graves, NMLS number 2190032 with Synergy One Lending Inc., NMLS number 1907235, Equal Housing Lender.
Equal Housing Lender. Gabby is going to memorize that by next week.
Yes, we are. I'm holding myself accountable right now. I am practicing that. Okay.
She is just going to be like slinging that number around after next week.
Absolutely.
Hello, everyone. We are so excited to be back for episode 2 of Not Your Mother's Housing Market. And we are discussing some fun things today.
We are, yes.
We are doing some myth busting. But, before that, we wanted to talk about one of our favorite things.
Myth busting.
Which is food.
Oh,
So
yeah.
Gabby has a great shirt on right now.
I give mortgage advice for tacos. So
yes. And I thought
hit your
it
girl
said,
up. It's Taco Tuesday.
We'll give mortgage tacos advice when I first read it. So I was like, mortgage tacos, and what type of advice do they need? Like what spice level of salsa they should put on? Are you a spicy or non-spicy?
I like spicy food. I used to not, but now I do. Yeah, I like spicy food.
I feel like I've gotten better with spice, but like my spice level is still a 1. But I'm like, oh my gosh, look at me. I'm eating so much spice, but really it's not spicy at all. We have been going to Siam Spice a lot lately, which is a Thai place that's right next door to my office.
Yes,
like every
on
time
Commerce.
we meet, we are going to Siam Spice. We're
Yes.
addicted to the peanut sauce.
I am addicted to the peanut sauce. I'd probably roll my man around in it if I could.
She would die for some peanut sauce. Last time we were there, she was like, hey, what food comes in the peanut sauce?
On this menu, what has this sauce just all over it?
Yeah.
And I wasn't disappointed, so go.
Yeah. Go to Siam Spice.
Delicious
Which
food.
also, what have you been up to since we were last here?
Honestly, the same thing. Like, I feel like you're going to ask me this every 2 weeks, and my answer's not going to change. I've done a lot of laundry. A lot of youth sports, honestly. Soccer. I'll give you a soccer update.
Okay,
So I'm
yes.
coaching youth soccer for my youngest son, and we've won all 3 games so far. Ooh. I know we're not supposed to keep score. It's youth soccer, so like the score is fun to fun, but really
Fun to fun? Is that what they say?
I think that
is the cutest thing I've ever heard.
We have stomped them all 3 weeks in a row, and I'm so proud of my little kids. They're so incredible, and they're such good kids, and I just adore them. And
yeah.
I don't know anything about soccer, and I have a great assistant coach that is teaching me. And yes, I'm pumped.
So
I'm
I can
super
say
pumped because I'm not competitive. So now I have these kids
so
that are little
competitive.
soccer stars.
I'm so
and
competitive.
I'm like learning to be very competitive.
I coached my daughter's, she was 5 at the time. I coached her soccer team last year and we were undefeated. So I'm just saying that I was also keeping score, but we were also undefeated. So I'll touch base with Gabby at the end of her season to see.
It feels so good. Oh my gosh, they're so adorable. You should see these kids after they score goals. They like run to the middle of the field like you see professional soccer players do with their arms out. They're adorable.
That is really cute.
So good.
Yeah. So what have I been up to lately? Oh, I was telling you this earlier, but I'll tell you guys. I am really good at compartmentalizing my feelings. Like, I feel like it's one of my biggest strengths and also one of my biggest weaknesses. So sometimes I don't even know stuff is like emotionally going on with me because it's like shoved so far back in like a box in my mind. But I have realized that I'm stressed out right now. I don't feel stressed.
How did you discover this?
Well, see, I don't feel
What
outwardly
cracked that
stressed.
box open and it was all the way back there?
Yeah, I don't feel outwardly stressed, but one of my tells is that I start having really crazy dreams.
Okay, for sure.
And so it's like consciously, I'm feeling good, I'm feeling great. Subconsciously, I'm going crazy. My dreams have been out of this world. But one of them that was like kind of normal, but also terrifying is I had a dream that it was Christmas morning, like it was December 25th, and I hadn't gotten a Christmas tree and I hadn't bought any Christmas presents.
Oh, that's terrifying.
It was like the worst dream ever. And I was running around the entire dream, like
That's awful.
trying to create Christmas in one day. And I was just like, how did I let this happen? Like, I'm the worst person in the world. So anyway, I'm feeling good, and hopefully this podcast, I seem like I'm feeling like a regulated person.
I'm having night terrors, but I'm feeling great, and everything's fine.
So one thing that has got some people stressed out is all of this mortgage things that are coming out in the news.
Oh, yes.
So to bring us back to where we're supposed to be.
Back to, we'll loop in night terrors into mortgage myths.
Well, honestly, I was talking to one of my clients and I told her about my dream because she's my friend in real life. And she said that she was having dreams about their house closing. Like she was having nightmares about their house closing all the time. So I feel like honestly, it's not that far of a stretch because
no, not at all.
People have nightmares about buying and selling houses all the time.
For sure. I think that, I've heard multiple times over life that it's, I don't know if it's through studies or whatever, but marriage, death,
and mortgage
and buying and selling a home are some of the most stressful things that you can do, or moving in general. I think it was moving in general, but buying and selling probably just amplifies that a whole lot.
Yes. I can see that.
We try to, one thing I love about you, and I think all realtors really try to achieve this, but you do a really great job at it, is you make your borrowers feel at ease and that this is a fun process and we are going to be excited about the other side of this journey.
Yes.
So you do a really good job at that.
Thank you so much.
Makes them not feel so overwhelmed.
Thank you so much. I actually laugh sometimes because my clients will be talking to like someone that we both know or whatever and be like, oh, Katie did such a great job and she led us through the process and it was so stress-free and blah, blah, blah. And I'm so happy that they feel that way because it's like little do they know that I was crying
and
every
that's the
day.
goal. Right. And that's the goal actually, is that we want to take that on. We want to take on the stress because we want this to be a fun experience for you, right? That's why we're here.
Yeah. I'm a stress sponge. That's what I say is one of my biggest jobs in real estate is I'm a stress sponge and I try to absorb all of it. And maybe that's why I'm so good at it because I just put it in a little box in the back of my mind and compartmentalize that stress.
And open it up later when we need to.
Okay, so today's topic, trending mortgage topics, TMT 23. So what is being talked about in the mortgage world in 2023 and, what is being said in the media versus what is actually happening. So we have two trending topics in particular that we are going to cover today. Mm-hmm. So what is the first one for us?
Hold on, I pressed the wrong button.
Okay. We have our laptops today because we're very official. We're talking about things. We're making sure that we're saying the right words.
Of course.
Right words.
Citing the right people to give them credit.
Yes.
Okay, so first thing we're going to kind of discuss is the change in mortgage insurance premiums and the cost of it. So mortgage insurance premium. What is that? Mortgage insurance premium is what is paid by homeowners who take out loans backed by the Federal Housing Association, so FHA loans. FHA-backed lenders use mortgage insurance premiums to protect themselves against higher risk borrowers who are more likely to default on loans. When you take out an FHA loan, you will pay mortgage insurance for the life of the loan. Whereas under conventional loans, you pay mortgage insurance if you own anything less than 20% value in the home. So if you put less than a 20% down payment, then you'd also pay mortgage insurance. Specifically, what we're talking about right now for an update is mortgage insurance on FHA loans. March 20th, the cost of that came down. Mm-hmm. So previous to March 20th, the monthly mortgage insurance portion for borrowers was 0.85%.
Okay.
It is now lowered to 0.55%.
Oh my goodness.
So what does that look like in real dollars, right? Because those are just percentages. Like, what does that actually mean? According to a White House fact sheet, it is saving FHA borrowers about $800 a year annually in mortgage payments via their mortgage insurance being cheaper. Okay. So this is great news for new home buyers who are wanting to get into the game. Your monthly mortgage insurance will not cost as much. That means your monthly mortgage payment won't be as high as it would have been previously to March 20th.
Yeah. So how I like to explain mortgage insurance, and I think this is, we're myth busting today, but the most widespread common misconception about purchasing a house is that you have to have that 20% down payment to be able to purchase a house. And that really did used to be true, but that's when mortgage insurance got introduced to lending to
Correct.
make it so you did not have to bring 20% down. So basically, mortgage insurance is really kind of an insurance premium you're paying to your lender because you are a little bit riskier because you didn't bring 20% of your loan down.
Right.
So
it helps mitigate that default risk, if you will. Yes.
Yeah. So the mortgage insurance is basically what you are paying so that you can bring a smaller down payment down. So like Gabby was saying, you can pay mortgage insurance on a conventional loan.
Right. If you have less than 20% equity in your home.
Mm-hmm. But then that drops off once you hit The 20% mark? Is that
So
correct?
it actually automatically falls off once you hit
18%?
22%.
22%. I
It
knew it was
automatically
off by
falls
2.
off.
Okay.
But you can request an appraisal on the home. And so let's say you're like right at 20, you think you are, maybe, you ask Katie and you ask her to do a valuation of your home and you believe it's right at 20% and you already have a conventional loan. You can request an appraisal to have that taken off. If you don't do that, it automatically comes off once you own 22% equity in the home.
Yeah. So basically the difference between conventional mortgage insurance and FHA, VA, USDA. VA doesn't have mortgage insurance.
It doesn't have a monthly. No,
Okay.
It has like an upfront fee, but that's a different topic.
That's getting into the weeds there.
And different loan program.
But anyway, so there is a difference between conventional and FHA, where the conventional mortgage insurance will drop off. It's an automatic trigger once you pay off a certain amount of your house, where the FHA
22%.
Yes. Where the FHA stays for the life of your loan if you don't refinance out
Correct.
of it. So the fact that they are
Making it more
lowering
affordable.
the price for FHA. So this has nothing to do with conventional loans. What
Correct.
we're talking about right now, it is just FHA.
Correct.
Yes.
And what they're doing is they're making it more affordable monthly for people to be able to purchase a home. Because that's a big factor right now with home prices at what they're at and interest rates at what they're at. It's not so much, there's down payment assistance programs, things like that help people with their down payment. It's more so that monthly mortgage payment and people being comfortable with that price tag. And so the fact that FHA is making it more affordable with this mortgage insurance premiums is really helpful.
Yeah. So have you found that your buyers are excited about it? Have you found that lenders are excited about it? Like, what is the general feeling about this news that came out in March?
It's caused a lot of buzz, and I definitely see where it's helped my borrowers for sure. I have a few people where they were right on that line, of is this too much? Is this not too much? And just the fact that this happened made them feel a little bit more comfortable. Even though it saved them, say, $80 a month, you wouldn't think that would make a big difference, but it really does, especially when you're on that, that edge of comfortability and paying.
And correct me if I'm wrong, but really that $80 a month can kind of change some people's pre-approvals a little bit, where they're approved for a little bit more.
Right. So absolutely. Mortgage insurance is a part of your monthly mortgage payment. And so that directly affects your debt to income ratio. So the fact that they decreased how expensive the monthly mortgage insurance is helps your debt to income ratio just a bit. And so it definitely, it's helping people qualify that a little bit better that are right on that line. It's also the biggest place that I'm seeing is it's making people feel more comfortable with their monthly mortgage payment. So it's making them feel more comfortable taking the jump into being a shopper.
Okay. That makes sense.
Yeah.
And lenders are excited about it too, I'm guessing.
Absolutely.
Yeah.
Yes. Any improvement that we can see that helps home ownership become more affordable in this market, we're excited about.
Yeah. So, okay.
That affects all FHA loans, which means all lenders, whether you go to a credit union, you come to a direct lender like myself, you use an online lender, we all have seen this positive effect.
Great.
Yeah.
So that was the good mortgage news.
Yes.
The other mortgage news that's been in the headlines, it's not that it's not good, but it's very misunderstood.
I would say that it's actually good mortgage news.
No,
it's
I
being
agree.
reported as bad mortgage news.
Right.
So we're here to bust that myth.
We're busted myths. I was trying to make like a rhyme, but then all the words jumbled in my mouth, so I had to stop talking.
I was going to call us
Mythbusters?
Yeah, and I feel like that's maybe copyrighted. We probably shouldn't say that.
Well, something else is probably copywriters is, we were talking about this before, and we were talking about trending mortgage topics. And so I was like, TMT, trending mortgage topics. And Gabby thought I was talking about the Ninja
Teenage
Turtles.
Mutant Ninja Turtles.
Which I had to remind her that is TMNT. So now she is up to date on the Ninja Turtles, but she has 4 boys. So I don't understand that she doesn't know TMNT.
They didn't get super into Ninja Turtles. Okay. It was very short-lived. Yeah, that wasn't a big thing in our house.
Were they Power Rangers boys?
A little bit. I mean, they were more of the age when they were younger. It was all about Paw Patrol. That was like a huge, huge thing.
We were Power Rangers, my son. every single song, because every season is like a different cast and a different whatever. And so every single season has its own theme song, and the theme songs are hits. Like, go listen to the Power Rangers theme songs and you will just be dancing around.
Katie's like, it's how I start every Tuesday morning.
Basically. I want to actually sing one right now, but I won't. So
That's
I'll just
funny,
have it
actually.
playing in my background.
I had a song of the day today, actually. It's like a Janet Jackson song. I posted it on my story. Go check it out.
Go look.
Go check it out.
Look.
Okay.
Okay, great.
So mortgage myth we're busting. So there's been a lot of talk in the news about LLPA changes. So what is LLPA? Loan level price adjustments.
LLPA.
Yes. So you've probably heard that they are making adjustments in the mortgage industry. The news is reporting that borrowers with better credit and larger down payments are now going to be penalized when purchasing or taking out a new loan, and people with lower credit scores and lower down payments are actually being rewarded off of the backs of more qualified borrowers. That's kind of what the news is projecting.
And then this is what I'm seeing like on the interwebs, on TikTok, on
the TikTok.
Instagram, wherever, is people making jokes like, oh, I better go out and get 20 credit cards so that I can have a better mortgage rate. Like,
Right.
I need worse credit so that I can qualify for more house. And so we are busting that today.
Or I won't put down a big down payment. I'm going to put down the minimum down payment when, when before really what I wanted to do was put down a huge down payment so that I could save in the monthly mortgage insurance, things like that.
Yeah. So we are going to be talking about some of the myths and then the realities of that. I went online and I did find a myth myth sheet on gmfsmortgage.com. So I'm going to be reading off some of the myths, and then Gabby is going to be talking about the truth behind it. So the first one and the biggest one, and this is really where all the memes are coming from, is lower credit scores get the same rate as higher credit score borrowers, or maybe even better. People are saying that like you are getting better rates if you have a lower credit score.
Okay, so that is a myth.
Yes.
So what has happened is with every credit score comes a certain price. They're called loan origination points. And so with lower interest rates, your permanent interest rate comes higher points. With a higher interest rate comes lower points. So the myth is that people with lower credit scores are now going to be able to get maybe the same interest rate for cheaper than what someone with a better credit score is. And that's actually not true. What is happening is they're decreasing the gap, if you will. So someone with a really high credit score and a large down payment, maybe before the points they were paying on a certain interest rate maybe have gone up just a little bit, where before how do I explain this? The spread between the two was larger. Now they've decreased the spread. So people with lower credit scores and lower down payments are not being penalized as much on their pricing. And people with higher credit scores and higher down payments are not receiving as much of a benefit. So are people with higher credit scores paying more? No. Especially if you, so let's bust this myth real quick.
First of all, can I say this? And I think this is really important too, because even on the real estate side, I didn't fully understand this, and I don't think most people are getting this part of it. This is kind of getting into the weeds, but I think it's important. So what is being changed is not the interest rate you are being assigned. What is being changed is the amount you are paying for that interest rate.
Right. So there's a price. So every day a new rate sheet is posted, right?
And I am sorry because my laptop sounds like it's going to explode because it's overheating. So I hope no one can hear that. Sorry to interrupt. Go on. Go on.
As a lender, every day I get a rate sheet, okay? And that rate sheet has a list of rates and a price associated with that rate. So how many loan origination points are going to be charged for that rate. Those points depend on your LLPAs, your loan level price adjustments. So depending on your credit score, depending on how much down payment you are going to put down on the loan, this depends on how many points you're going to pay for a particular interest rate.
So basically, if you have good credit, if you are paying a higher down payment, it is cheaper for you to get a lower interest rate.
Correct. Okay. So for instance, I have an example here.
Oh my gosh, my laptop really does sound like it is going to explode. So while she is talking about this, or are you looking?
I'm going to pull that up, but real quick. So going back to what I was saying before, will people with higher credit scores and higher down payments be paying more in points than someone with lower credit? Absolutely not. The pricing is still going to be better. If you have a higher credit score, don't go ruin your credit because you think you're going to get a better loan. That's not true. So if you have a higher credit score or higher down payment or both, you are traditionally going to be getting better pricing than someone with the opposite. It's just that the people that have lower credit and lower down payment, their pricing is now not going to be as high.
Yeah.
Their penalty is not going to be as high for that.
So it is true that you're paying a little bit more if you have better credit, and it is true that you're paying a little bit less if you have bad credit, but you're still in two different brackets. You're still paying less if you have good credit and a high down payment than you would be paying if you had bad credit and a low down payment.
Far less. Exactly. Yes. So for instance, here's an example of effectively,
and where did you find
this is from, let's see here. This is from Mortgage News Daily from an article written on January 19th of this year by Matthew Graham. The article's name is Some Big Changes to Mortgage Costs Were Just Announced. So if we are looking at, let's see here, the effective penalty for having a credit score under 680 is now smaller than it was.
Okay, so you're not getting penalized as much.
Exactly. It still costs more in fees to have a lower credit score. For instance, if you have a credit score of 659 and you are borrowing 75% of your home's value, meaning you're putting down a 25% down payment, you'll pay a fee equal to 1.5% in points. Whereas someone with a credit score of 780 or more won't have additional points. So it always pays to have a better credit score. It's just that you might not get as much of a benefit before, and you might not get as much of you won't get as much of the stick, if you will, having worse credit.
Okay. And so then next myth is that today we are recording on May 2nd. By the time you see this, it won't be May 2nd, but just so you know, today is May 2nd. And so this rate really came into effect on May 1st. So yesterday.
Correct.
But the myth is borrowers will see a big rate increase on May 1st.
I believe that's, in my opinion, that is also false. And the reason why is because these rate increases have already, in most lending companies, we've already taken it to effect in our rates, in our prices. And so anyone that's been applying in the last month or so, you've already been seeing these rate adjustments in what we're quoting you for fees and closing. So I don't see there being a big jump. No.
Well, as we noticed, the date that she said on the article that you read was what, back in January?
January 23rd. So this was announced at the beginning of the year.
Yes. And so these mortgage lenders have known this was coming down the pipeline. It affects all mortgage lenders the same, correct?
Equally. Exactly.
So they've known that this is coming down the pipeline. So it sounds like you guys have already kind of been making those adjustments as you go.
We've had time to add in this pricing change into our rate sheets. So what happened on May 1st is it became mandatory that we institute this. Most lenders have instituted this far previously. Okay. And real quick too, this is only on conventional loans. So these loan level price adjustments are only with Fannie Mae and Freddie Mac. Those are going to be
Fan and Fred. Those
are going to be just for conventional loans.
Okay.
So this does not affect your pricing on FHA, VA, USDA loans because those are government-backed loans.
Okay. So kind of we'll probably touch on this again, but this is interesting because these two pieces of trending mortgage topics, one of them, the first one, only affected FHA loans, government-backed loans. And this one is only affecting Fannie and Freddie loans.
Correct. Conventional loans.
So these are two different things that are not to be conflated. They are both affecting different types of loans, which at some point we'll probably do an episode that just breaks down all the different type of loans. But that's, something to keep in mind when you're talking to anyone about this news.
Right.
Okay. So were we done with that?
So you just brought up the myth
Oh,
of,
yes, May 1st.
will we see a huge price increase May 1st? No, we
Yes.
don't believe
Okay.
so because most lenders have already factored this in months ago.
Okay. And another myth, which is not on the list, but I think is going around, is that this will affect your interest rate even if you already own your home.
So if you have an existing loan that is already closed, this will not affect you. This is not affecting, if you have a closed loan, you've been making your mortgage payments, this is not affecting you. This is affecting people who are closing on new mortgages, homes that have not finalized yet, and new mortgage applications.
Right.
Again, for conventional loans, not FHA, VA, USDA.
Okay. Yeah. Okay. Great. Okay. So another myth is that this is the first time that they've done a change to LLPAs.
Right. So that is also false. LLPA changes take place. I wouldn't say frequently, but it is something that's definitely been adjusted over time. So Freddie Mac, Fannie Mae and Freddie Mac are government-sponsored entities. They're not government-owned, but they are government-sponsored. And they have been since 2008. And so there has been small incremental changes in LLPAs over time. Sometimes they get pulled back.
Okay.
There was a large LLPA change on investment properties at the beginning of the year. And soon after they made it, they retracted it. And so these changes are kind of fluid. We could see some of these changes go into effect for a while. They could take some of them back. They could change other parts of pricing.
Okay.
It's all they're trying to make home ownership more affordable, especially for first-time home buyers. And so this is a way to try to get more buyers into the market. Specifically, I think to try to counteract increasing rates.
Okay. And so I think that kind of pulls us to one of the biggest myths is that, this is going to dramatically and negatively affect the housing market. But really, like you said, these changes are put into place, much like the other change that we talked about earlier, to make home ownership more affordable.
Correct. So what does this mean for your high credit score, high down payment borrower? Well, you're still getting a great deal. You're still getting a greater deal compared to maybe someone with not as large of a down payment and lower credit score. You're still getting lower fees, better interest rates. It should not at all keep you out of the game of purchasing your dream home or purchasing your next home. As for people who are not homeowners right now, it is now a little bit cheaper for you to get in the game. So it's a great time for you to get out there and try to get pre-approved so that you can see what your purchase price range is.
Right. And I think another really important thing to keep in mind is that it is nothing that those borrowers who have worked really hard to have great credit and to have a large down payment, you don't need to be resentful towards those people who are purchasing that have lower credit scores and lower down payments. And I think that is one part of the rhetoric that I'm seeing a lot is resentment towards the people that are getting a little bit of a benefit. Have you ever heard the saying that it's like,
sorry to interrupt you, but that leads to our next myth as well. But what were you saying?
No, you go first.
Just the fact that basically the people with better qualified borrowers are now paying for the less qualified borrowers
is the myth.
And that is actually not true. And so this is a statement put out, a public affairs statement put out by the Federal Housing and Finance Agency by their director, Sandra Thompson. And she said,
Sandy.
Good old Sandy T. So let me address some of the misconceptions directly. One of them she addresses is some mistakenly assume that the prior pricing framework. Oh, that's the wrong one. Excuse me.
That's what happens when you're doing this live.
I know,
no editing.
Right? No editing. Where is it? Let's see here.
Oh, right. The very top one.
Okay. Yes. Thank you, Katie.
You are so welcome.
Higher credit score borrowers are not being charged more so that lower credit score borrowers can pay less. The updated fees are true of prior fees, generally increasing as credit scores decrease for a given level of down payment.
So basically that's just saying you are still getting a better deal if you have better credit scores.
Exactly.
Yeah.
And the other one I was looking for was essentially there's a statement in here about how this risk is now being put more on the mortgage insurance. So they decrease these fees for what you might call a little bit less of a qualified borrower. And didn't equally decrease for higher qualified borrowers because they're putting more of that risk on mortgage insurance companies.
So it's
right?
really not going towards the better qualified buyers. Like it's really being absorbed by the mortgage insurance.
We're not taking money away from better qualified borrowers and handing it to less qualified borrowers. That's not what's happening. They've adjusted their pricing by looking at the risk that they're absorbing and putting some of that risk onto mortgage insurance, which is what the purpose of it is in the first place.
And, kind of our last myth, I would say, that we're busting is basically like, some people, especially, on the internet, they want clicks and they're saying, oh my gosh, this is going to create like a mass foreclosure crisis. And the idea behind that is that maybe people that have those lower credit scores and that don't have as much of a down payment aren't qualified to be purchasing these houses. But, just because this is coming into effect doesn't mean that all the other standards that they have to meet aren't being met. Like, the credit score that was cited earlier in the article Gabby was reading was a 680, which is still a great credit score. So this is not saying like, oh, hey, we're going to start lending money to all of these people who can't afford it. It's really just making it more affordable for those people who are qualified but don't have quite the credit score and down payment as other qualified buyers.
So brass tacks, what it really comes down to is the qualifications to get a mortgage have not changed. But for somebody that has maybe a lower credit score, lower down payment, the cash that they have to bring to the closing table might not be as high because they're not going to pay as much in fees to access that interest rate.
And don't we all think fees should be lower? All the people that are like hating on this, it's like, aren't we happy that not everyone's having to pay crazy high fees for things?
I think the worry is that people are concerned that for people with the higher credit score, higher down payment, that their fees are astronomically going to jump up. And that just isn't the case. That's not what we're seeing. It wasn't an equal it wasn't an equal gain from one and an equal takeaway from the other.
Right. And yes, what I was going to say earlier, and kind of I think it speaks to both of these, is have you ever heard the saying that it's expensive to be poor?
No.
You've never heard that saying?
That. No.
Oh my gosh. Okay. This really changed my life when I saw a video about this. I don't know, probably like 7 years ago. It was a long time ago. Okay. I love a good video. But, it's kind of the idea that it is expensive to be poor in the fact that, like, okay, let's say that two people just got a new job and they have to have work boots. And one of them has the money to buy a $100 pair of work boots, and they have those work boots for years. And then someone else who isn't in quite the same situation has to buy a pair of $20 work boots. And those boots get ruined over and over and over again. So you consistently are buying $20 work boots.
Right.
And over the course of, however many years, one person, spent $100, that's all they spent. And the other person maybe had to, buy 10 pairs of work boots, whatever, and spent $200.
Exactly.
And for me personally, I've seen this in my life with Tupperware. Like, do you use glass Tupperware?
I do now.
Okay.
But I didn't when I was younger.
Yes. And I think that's a perfect example of, like, maybe you can say it's expensive to be poor, but it's also maybe expensive to be cheap is a good way of saying it too. Where it's like Tupperware, you buy it, you throw it away, you buy it, you throw it away, and it's like the nasty plastic stuff.
Yes.
And when I was younger, when I first moved out, I couldn't afford glass Tupperware. Like, that was like a luxury item.
Yeah, agreed.
So, I was buying plastic Tupperware all the time, and it was getting ruined all the time. And now that I have glass Tupperware, I bought it, 4 years ago, and I've had the same Tupperware for 4 years.
That's a great example.
So,
yes.
Yes. So it's expensive to be poor, or, it's expensive to have a lower credit score. And because it's expensive to have a lower credit score, it's hard to make your credit score better. And so these things that they're putting into place, I think they're trying to make it less expensive to have these credit issues so that people can dig themselves out of those credit issues and eventually have better credit.
Agreed.
And have more money for a down payment and be in a better position. And that's really what these are trying to do. They're trying to make, you're still paying the same for your mortgage, but you have less fees. Like,
agreed. We're not removing qualification standards. We're just removing a little bit of a barrier to entry because it is expensive to get your foot in the door the first time. A lot of people that your second time home buyers, they have some equity, some profit that they walked away with on the sale of their previous home. And so a lot of times these people do not have problems paying their own closing costs.
Right.
Where for first time home buyers, that is a struggle.
The fees add up.
The fees really add up. And so if we can decrease some of those fees at all, that removes that barrier to entry.
Yes, exactly. So yeah, I think
which
that's
is good
really
for whole housing market.
It's good for the entire housing market. And it's good for helping those people build wealth. So yeah, I think that is really the takeaway from both of these. If you take anything away, it's the fact that we're just trying to lower the barrier of entry. All of these people are still qualified. You are not getting penalized if you have great credit and a great down payment.
A healthy down payment.
I forgot the word.
You are still saving money.
You're still saving money overall from those other people, and it is not taking away from you. It is just trying to make the housing market more open to everybody as long as they are qualified. These people are still qualified. They just have a few dings to their credit or whatnot.
So if a mortgage lender is telling you that having good credit and a high down payment is a bad thing, you're talking to the wrong mortgage lender.
And that actually is what I want to finish this all up with, because even as a realtor, I didn't fully understand what was happening with these changes. And there is so much in the media. There's so much on social media about these changes, memes, funny jokes, but like, how do you parse through it all?
Right.
There's a lot of like, people want to create hysteria for clicks. People want to create, something to be mad about for clicks.
Right.
But how do you find out the truth is to talk to a trusted professional. So that is one of the reasons we're doing this podcast, so that you can hear from some professionals that understand what's happening in the market, what you're seeing in the media. And if you as a person ever have questions about these things, instead of, watching, someone talk about it on I was about to
TikTok
say,
or
someone
whatever.
talked about it on TikTok or whatever. Like, reach out and talk to someone, set up a meeting with your local professional.
Yeah,
and we would love to help anyone here locally.
Yes, absolutely. And we'd love to take your questions through our email as well.
Oh my gosh, she is always so good at reminding me to pump the email. notyourmothershousingmarket@gmail.com. It's so easy. It couldn't be easier.
Couldn't be easier.
And also follow us on Facebook and on Instagram at Not Your Mother's Housing Market. We posted a great reel the other day. We're making moves. We're doing all the things. We want to bring you this content, and we want to help you understand our housing market better. So with that, thank you so much for watching Not Your Mother's Housing Market. I'm Katie Keaton.
I'm Gabby Graves.
And we will see you next time.
Have a great day, guys.